Turning our attention right now to the danger of chasing vaccine stocks on news about vaccine development without the research to back that up. Nina Deka, Robo Global Senior Research Analyst, joins us now to talk about how investors need to still be cautious when making decisions. Good to have you here, Nina.
Thanks for having me.
So one of the things I know that you talk about is, there are ETFs that might protect your exposure to putting all of your investment into, say, a Moderna or J&J. What would you caution an investor who hears the headline about we're making breakthroughs, we're making advances, because we still don't have approval for a vaccine?
I mean, the biggest watchouts are that we don't know, or a lot of investors don't know to what degree a potential coronavirus vaccine might already be priced into the stock. Also, there's over 100 different vaccine opportunity programs that are under clinical trials right now. So it would require a lot of work and heavy lifting and research for for the average investor to decide which companies that they'd like to invest in. What we recommend is diversifying your options and holding a large group of great companies rather than just trying to pick one or two really good ones. And so if you were to try to determine which company is going to win in terms of coronavirus vaccine therapy, you might be missing out on some other really cool investment opportunities. For example, telehealth, areas like genomics, data analytics are very fast growing opportunities in healthcare right now. Virtual care is still at its very early days about adoption. So one way to capture all of this innovation happening in healthcare is with a healthcare innovation ETF, like ours, HTEC, ticker HTEC. It's up about 15% year to date, and it's outperforming a lot of other healthcare ETFs because it's more heavily weighed in some of these more innovative areas like genomics, robotics, telehealth.
This is an important thing that investor needs to pay attention to, and I know Melody has a question along those lines for you.
Sure.
Yeah, and Nina, I mean, you are making some reasonable, very rational, sound points, but in this era of the resurgence of the retail investor looking to win big and maybe taking some risky bets, even today we saw that Inovio Pharmaceuticals is down double digits after actually some promising data, but they did not disclose data about the participants' antibody response. This seems to be a moving target, right? So in some way, there could be opportunity, right? If perhaps stock is down 20%, I imagine that there could be still appetite for folks to say, hey, this is still worth investing in potentially when it's down.
Sure. And so what I would recommend those investors do is look at broader, longer term opportunities. For example, a couple of the companies active in the coronavirus research space are Moderna, for one, is in the HTEC index, actually. There's so much more to Moderna than what's happening with the coronavirus vaccine. First of all, the company is fully digitized, scalable. Everything they do involves artificial intelligence from the moment a scientist has an idea. And they have over 20 other active therapies under clinical trial right now. Also, if something gets approved with Moderna or with any other mRNA company, that will be a positive catalyst for all mRNA that's under development right now. To date, there is no mRNA therapy that's been commercially approved. So I would look at the longer term scalable opportunities beyond the coronavirus vaccine when trying to pick a winner. We think Regeneron is another really great opportunity.
Well, let me ask you about opportunities, because there's pushback in Congress. For instance, it's not just vaccine development. Bernie Sanders the other day was furious at remdesivir and the situation there because U.S. taxpayers help fund the research, but we're still paying what's like $3,200 with insurance coverage if you need the 5 treatments. But then you get something like diabetes. And insulin, there were the issues over how many companies produce insulin and the increase in prices there. So how does an investor protect themselves from the potential to Congress to step in here and push prices down and perhaps even confine the ability for pharmaceutical companies to make money?
I would continue to encourage investors to look for a broader diversified portfolio. So when you bring up diabetes, it's one of the hottest areas right now in med tech. And so what you might want to make sure you include in your portfolio is a company like Insulet, who has a new technology that's completely tubeless insulin pump that is also available through a pharmacy. So it's available to consumers at a much lower price point than the older types of insulin pumps. And so they also have a new technology that's in clinical trials right now that they're looking to launch and commercialize by the first half of next year, which is a closed loop system. And when that goes live, it's going to be tubeless. It's going to be talking actively to a continuous glucose monitor, and it's going to be available at pay-as-you-go price strategy through actual pharmacies. So there's an area where you could diversify your portfolio and protect it a little bit from some of the volatility that you might see with legislation and pricing.
Nina Deka, unfortunately, we're out of time. It's always good to have insight like yours. Thank you for joining us. Nina, by the way, is the Robo Global Senior Research Analyst. Please consider coming back in the future.
Will do. Thank you.